Are you tired of hearing about expensive tech stocks that are already priced for perfection? What if I told you the smart money, the real billionaires, are quietly piling into a different breed of opportunity? Today, we're diving deep into 7 cheap stocks with massive upside potential that most retail investors are completely overlooking. These aren't just value traps. They're fundamentally strong companies trading at a discount, poised for significant growth. Stay tuned, because by the end of this video, you'll have an exclusive list of overlooked gems that could transform your portfolio. Number 7. PDD Holdings Inc. Ticker: PDD. PDD Holdings, the multinational commerce giant connecting businesses and consumers through digital platforms. With a forward PE ratio of just 13.35 and 65 hedge funds holding positions, PDD shows significant institutional backing despite its cheap valuation. While the Chinese e-commerce sector is grappling with an intense pricing war, pressuring short to medium-term profits, PDD has continued to surprise analysts. The company recently topped Wall Street estimates with an EPS of $3.09, beating by over $1, and revenues of $14.54 billion. Co-CEO Zhao Jiazhen admits these profit levels might be unsustainable due to fierce competition, signaling potential volatility. However, PDD's cross-border marketplace, Temu, is a massive growth driver, projected to contribute 50% of total revenue by 2030 and achieve profitability by 2026. This aggressive long-term investment strategy, reminiscent of Amazon's early days, is why analysts like Sai He from CMB International Securities have raised price targets, maintaining a buy rating. Despite geopolitical risks and scrutiny, PDD's robust balance sheet with $54 billion in cash provides a strong foundation for its ambitious growth, making it a compelling, albeit higher-risk bet for future e-commerce dominance. Number 6. ConocoPhillips. Ticker: COP. ConocoPhillips, an exploration and production company focused on crude oil, natural gas, and natural gas liquids. Currently trading with a forward PE of 14.95 and attracting 72 hedge funds, ConocoPhillips represents a stable, value-oriented play within a crucial industry. The company has demonstrated a robust financial strategy, consistently returning capital to shareholders with plans to distribute $10 billion in 2025 through dividends and buybacks, aiming for a 3.3% yield. Despite mixed Q2 2025 results, an EPS beat at $1.42 but a slight revenue miss. Production numbers were strong, exceeding guidance at 2.39 million barrels of oil equivalent per day. Strategically, ConocoPhillips is firing on all cylinders. The integration of Marathon Oil is yielding over $1 billion in synergies, and major projects like the Willow project in Alaska, set for first oil in 2029, are advancing. Beyond traditional oil and gas, ConocoPhillips is also making decisive moves into low-carbon initiatives, investing in blue hydrogen and carbon capture. Analysts like Nitin Kumar from Mizuho Securities maintain buy ratings, even with slight price target adjustments, signaling confidence in its future performance and strategic diversification against commodity price volatility. Number 5. Wells Fargo and Company. Ticker: WFC. Wells Fargo and Company, a financial services giant offering a wide array of banking, investment, mortgage, and finance products. With a forward PE of 14.42 and favored by 75 hedge funds, Wells Fargo and Company is a big bank poised for a turnaround. A pivotal moment for Wells Fargo was the lifting of the long-standing $1.95 trillion asset cap by the Federal Reserve in June 2025. This regulatory relief, 7 years in the making after past scandals, unshackles the bank, allowing it to expand lending and deposit-taking significantly. While the full impact won't be immediate, it signals a new chapter for growth and market share expansion. The bank exceeded Q 2025 earnings expectations with an EPS of $1.54 and recently increased its quarterly dividend to 45 cents, yielding 2.3%. Analysts, like John Pancari from Evercore ISI, have raised price targets to $98, maintaining an outperform rating, anticipating solid Q3 results and full momentum by early 2026. Despite ongoing legal scrutiny and governance reforms, Wells Fargo's strong liquidity and renewed operational freedom position it as an attractive cheap play with considerable upside as it reestablishes its market leadership and returns value to shareholders. Number 4. Comcast Corporation. Ticker: CMCSA. Comcast Corporation, a global media and technology company known for Xfinity, Comcast Business, and Sky. With a remarkably low forward PE of 7.34 and a significant 82 hedge funds invested, Comcast Corporation stands out as a deeply undervalued media giant. The company consistently generates strong free cash flow, including $4.5 billion in Q2 2025, allowing for a healthy 4.4% dividend yield and a new $15 billion share repurchase authorization. Comcast's Content and Experiences segment is a key growth driver, with the highly anticipated Universal Epic Universe opening in Orlando in May 2025, set to boost theme park revenue. Its streaming service, Peacock, is also gaining momentum, reaching 41 million subscribers and narrowing EBITDA losses. However, Comcast faces intense competition in residential broadband, losing 226,000 customers in Q2 25. In response, they're pivoting, focusing on multi-gig symmetrical speeds and bundling broadband with mobile services. Analysts like Jessica Reif-Ehrlich from Bank of America Securities expect Q3 media EBITDA to improve, partially offset by theme park attendance. Despite these challenges, Comcast's strategic asset sales, like the $9.4 billion gain from Hulu, and focus on high-growth areas position it for a rebound, making it a compelling cheap stock with significant upside potential if its broadband strategy pays off. Number 3. Pfizer Inc., ticker PFE. Pfizer Inc., the global biopharmaceutical company behind countless medicines and vaccines. With a forward PE of 7.71 and a strong following of 83 hedge funds, Pfizer offers deep value alongside a robust dividend. Recent news of a groundbreaking deal with President Donald Trump to lower Medicaid drug prices in the U.S., aligning with prices in other developed nations, positions Pfizer as a key player in healthcare reform. In return for tariff relief and a 3-year grace period, Pfizer has pledged $70 billion in domestic manufacturing and research. Financially, Pfizer reported strong Q3 2024 results, with revenues up 32% year-over-year to $17.7 billion, driven by acquired products like Seagen's oncology portfolio and existing blockbusters. They raised full-year guidance and maintained a consistent 43 cents per share quarterly dividend, a testament to 14 consecutive years of increases, offering a fantastic 6.8% yield. While facing a patent cliff from 2026 to 2028 affecting key drugs, Pfizer is aggressively bolstering its pipeline, going all in on the obesity market with its experimental oral GLP-1RA, danuglipron, and significant investments in oncology. Analysts like Tim Anderson from Bank of America Securities reiterate a buy rating, seeing Pfizer as a resilient pharmaceutical giant navigating industry shifts with strategic foresight. Number 2. Merck & Company, Incorporated, ticker MRK. Merck & Company, Incorporated, a global healthcare powerhouse developing prescription medicines, vaccines, and animal health products. With a forward PE of 8.8 and an impressive 92 hedge funds holding positions, Merck represents a high-quality dividend play with substantial growth catalysts. Despite a mixed Q2 2025, where EPS beat estimates but revenue saw a slight decline, Merck updated its full-year sales guidance, anticipating a return to growth in the latter half of the year. A major focus for Merck is proactively addressing the impending Keytruda patent cliff in 2028 by aggressively diversifying its pipeline, projecting over $50 billion in potential new revenue from 20-plus blockbuster products by the mid-2030s. Recent successes include the launch of Capvaxive for RSV prevention, FDA approval for Enflonsia for infant RSV, and breakthrough therapy designation for a lung cancer drug. The introduction of Keytruda Klex, a convenient subcutaneous formulation, could also extend its market contribution. Merck's commitment to shareholder returns is evident with 55 consecutive years of dividend payments, currently yielding 3.7%. With 80 Phase 3 clinical programs and a $3 billion optimization program, Merck is a healthcare titan innovating its way through patent challenges, making it a compelling, cheap pharmaceutical investment. Number 1. The Progressive Corporation, ticker PGR. The Progressive Corporation, a leading insurance holding company. With a forward PE of 13.28 and an incredible 99 hedge funds invested, Progressive is clearly a favorite among institutional investors, indicating strong confidence. Progressive delivered a robust Q2 2025, showcasing a staggering 118% surge in net income to $3.175 billion and EPS climbing to 5.42, comfortably beating analyst expectations. This impressive profitability was driven by an 18% rise in net premiums earned and a significantly improved combined ratio of 86.2%, signaling strong underwriting performance and lower catastrophe losses. The personal lines segment saw a 15% premium increase and a 1.5-point market share gain in 2024, its largest in 15 years, fueled by data-driven pricing and aggressive marketing. Progressive's strong balance sheet, with total assets at $115.480 billion, further underpins its financial stability. While facing challenges in commercial lines and customer retention, analysts project a 36.6% EPS increase for Q3 2025, with a 2.0% dividend yield and an average price target suggesting 17.5% upside. Progressive is a resilient, profitable, and strategically sharp insurance play that remains cheap relative to its growth and market leadership. Now, let's take a closer look at the numbers. The data reveals some truly compelling opportunities. When we look at current price, we see a wide range, from Comcast at a highly accessible $29.46, all the way up to Progressive at $240.26. This diversity means there's an entry point for almost any investor looking for value. In terms of market cap, Wells Fargo leads the pack as a financial behemoth at $256 billion, followed by Merck at $219 billion and PDD Holdings at $173 billion. Compare that to Comcast and ConocoPhillips, both at $109 billion, offering a blend of established scale and potential for faster growth. Revenue tells a similar story of impressive scale. Wells Fargo dominates with $126 billion, closely followed by Comcast at $124 billion. Even the smaller players like Pfizer and Merck are pulling in substantial top-line numbers at $64 billion each. Gross margin is where profitability truly shines, with Merck boasting an incredible 75.25%, Pfizer at 67.34%, and Comcast and PDD also showing strong margins above 57%. Wells Fargo and Progressive, being financial services companies, show 0% gross margin as their revenue model is different, focusing on net interest income and premiums. For income-focused investors, Pfizer stands out with a robust 6.8% dividend yield, while Comcast offers a healthy 4.4%, and Merck and ConocoPhillips deliver yields above 3%. PDD, a growth-focused e-commerce player, reinvests its earnings. Finally, earnings per share, or EPS, reveals who's truly making money for shareholders. Progressive absolutely dominates here with a staggering $17.76 per share, followed by PDD Holdings at $9.17 and ConocoPhillips at $7.45. Even with a lower current price, Comcast is putting up a strong $6.06 EPS. These numbers clearly highlight why these companies, despite being cheap, are backed by solid fundamentals and significant growth potential. So there are 7 incredibly compelling, yet cheap stocks that are attracting significant smart money and offer substantial upside for discerning investors. Which of these 7 cheap stocks are you adding to your watch list, and why? Drop your thoughts and insights in the comment section below. I love hearing your perspective and sparking a great discussion. And check out our video right here on 7 undervalued tech stocks that could explode in 2025.